Good morning, friends. Today we are talking about what is happening in market. There are a lot of questions on the minds of the investors in terms of how they should look at market today. And we thought that this is a good opportunity to just give you different perspective in terms of how we are thinking about the market right now. So let us start with the macro construct. The macro construct globally and domestically still remains in a conducive zone, and we have been saying that for last 6-8 months or a year. So when you look at the monetary and fiscal policies that are in place, I think they continue to drive the demand environment, aggregate demand environment. They continue to basically create additional demand levers for emerging markets, as well as at the margin the inflation is actually playing through the top lines of the corporates of the emerging market companies. So when you look at this macro environment where you have basically the kind of monetary and fiscal policies in place which are driving aggregate demand, it in turn also means a conducive liquidity environment, both from flows perspective, capital flows perspective, as well as banking flows, banking liquidity in the emerging markets and countries like India in particular. And that's what we are experiencing. While there will be a little bit of care here and there in terms of inflation, there is still belief, and particularly this belief is based on what the 10-year GSEC of US is indicating, that you are going to have this inflation which is going to be more transitory. Will these policies taper off? Of course, these policies will taper off eventually. You are experiencing the kind of growth in US, Europe, which you did not experience for a long period of time, and that's largely to do with this kind of policies that are in place. They will taper off gradually as economy normalizes, as COVID goes away, as more vaccination happens. Already almost 40-50% vaccination has happened in some of the developed countries. As that happens, these policies will taper off. Will this tapering off have a significant impact on emerging market flows? I think this is a question which is on the minds of most of the investors. Our take is, if this tapering happens in an environment where the economy has normalized and where the growth rates are elevated as compared to at least last 5-7 years in most of the geographies, probably the context of growth vis-a-vis inflation and tapering would matter more rather than just tapering. So if the tapering or the reversals of these balance sheet expansions happens along with the growth revival, there will be minimal impact, and that's the past precedences. So that's the global macro environment, which is I think conducive. It remains conducive as things stand today. Coming to domestic piece, we clearly on domestic side we experienced a little bit of hiccup in terms of the growth because of the 1.5 months of lockdown that we experienced in last quarter. That has also led to the GDP growth rate being shaved off by about 100-150 basis point, as well as the corporate earnings not getting upgraded for this particular quarter at least. So after 4 quarters, for the first time, we experienced the quarterly earnings not getting upgraded for the timing. But do we see this as a kind of end of earnings upgrade cycle? As of now, we have reasons to believe otherwise. I think it is more postponement of corporate earnings or demand rather than the extinguishing of that demand itself. So that's the view that we are taking as of now, and this is contingent upon several factors. And why we are thinking that, see, just to actually step back and look at the corporate earnings, last 4 quarters we experienced about 20% earnings upgrades, and this upgrade has been led by both domestic general discretionary spending revival, the housing revival, the industrial revival, as well as the external sector doing really well. When you look at it in terms of basically the sectors, clearly there are external oriented sectors like IT, pharma, chemicals, auto exporters, engineering exporters. All of them have been beneficiaries in a way, or will continue to be beneficiaries at least for next few quarters in terms of strong external demand environment or supply chain rejig that is happening in some of these sectors at the margin from one of the other country. That's the external piece. Coming to domestic piece, clearly you have sectors like banking, like discretionary spending, the housing, which were impacted because of the kind of lockdowns as well as disruptions in the economy. As the country gets vaccinated more and more, you will have opening up, and as that happens, most of these sectors are likely to experience improved aggregate demand as well as improved credit growth as far as banking sector is concerned, which is still languishing at about 6% of credit growth. So all in all, the take still remains on the domestic side that the earnings revival is in place. It is driven by external sector as well as domestic sectors, and thus the earnings growth of about 30% for financial year 22 and about 15 to 17% for financial year 23 doesn't still look like under question mark. And that's where our confidence that the earnings cycle is not broken, it is just probably postponed for a quarter or so. That's the earnings part of it. Now, when you think about the valuations, clearly from near-term perspective, valuations at about 20 times or financial year 23 or 22, 23 times financial year 22 are clearly one and a half standard deviation higher than the historical valuations. And from a statistical perspective, they are clearly not cheap. But when you look at the valuations, we have to always look at the valuations in the current context, particularly from two angles. One is what is the opportunity cost of investors? When the cost of capital is so low, you might not experience the same valuation multiples, at least statistically, which you experienced in the past. That is one. Second is also there is a cyclical recovery underway. So if you step back and actually look at what has happened to several sectors over last 10 years, and that is an easier way to explain it. You look at commodities, you look at banking, you look at auto, you look at housing, you look at industrials, you look at something like generic pharma. So lot of sectors themselves for last several years were going through their own challenges of earnings, and most of them are actually coming back cyclically in terms of earnings growth revival. Some of them because of the external aggregate demand revival, some of them just because of the replacement cycle, or particularly in case of banking, it is just that the banking sector is getting out of a long NPA cycle which it experienced between 14 to 20, and the bank balance sheets are now clean and they're ready for credit growth. So clearly when you look at it from cyclical perspective, we would assign a far higher weightage to what could happen to a lot of these sectors given the deleveraging that has happened in corporate India, given the credit cost cycle which is over from banking perspective, given the availability of in a way cheap capital or easy capital at a higher valuation, both risk capital as well as cost of capital on the debt side has reduced. So when you actually combine all those factors, you clearly seems to be in a position where both the corporates and banking system has gone through a long deleveraging cycle in a way, or NPA cycle in a way, and you are ready for a upcycle. At the same time, what is also happening is that finally after very long period, government is giving a push to growth, be it through the direct intervention, which is fiscal measure, which is about 1.3% or about 2 lakh crore rupees of additional spending that is going to happen in financial year 22, or through the non-monetary measures like import substitution, PLIs and other. So both from government policies perspective, from fiscal intervention perspective, and from the perspective of corporate balance sheets being deleveraged over a period of time, and availability of kind of capital at a higher valuation in itself, and then availability of banking system which can actually provide credit for growth. When you look at all these factors, it looks like you are in a cyclical upturn, and that's where we don't want to actually beyond a point just give weightage to near-term valuations. Are they expensive? Yes, they are clearly little expensive than the historical valuations. To that extent, you're going to probably witness more consolidation or sideways movement in market for some time to come, and that's where probably sectoral rotation, market cap rotation is more of an expectation than a very broad-based rally that we have experienced in last year or so. So that's the way we are looking at the valuation part of the market. Coming to the portfolios, given the construct that I told you, very strong global or very conducive global macro construct, domestic economy which is reviving both in terms of cyclical recovery in several sectors, the government's intent towards growth, and the deleveraging that is happening in the corporates, it is clearly evident that probably there will be at the margin rotation from the externally focused sectors to domestically focused sectors or opening up sectors. So financials, discretionary, retail, cement, housing, industrials, these are the spaces where our portfolios are generally overweight as compared to the externally oriented sector where the portfolios were far more overweight through last 1 year. Will the externally oriented sectors continue to do well? They will continue to do well, but we think that a lot of it is discounted in terms of earnings upgrades, whereas on the domestic opening up sectors, they are still available at a relatively fair valuation or cheap valuation in case of certain sectors when you look at them from a cyclical perspective. Given this construct, we think that we are in a cyclical earnings recovery, and if that is the context, looking at the near term valuation beyond a point might not help. And given this thesis, we think that investor should stay invested through SIP route in the market, focus on wealth creation over medium term rather than focusing on what is happening every month or every quarter. And as I always say, that basically spending time in market is more important than trying to time market for wealth creation. So focus on that rather than the day-to-day noise that happens. Happy investing. Good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.